Welcome back to my channel, and we have another exciting topic to discuss with all of you guys out there. And I appreciate you watching us. And anyway, my guest is no other than Julie. Of course, hello, Julie.
Good morning, Seewing. How are you?
Uh, Fine, thank you so much. Yeah, without further ado, let me go ahead and share my screen and let's get the ball rolling. So today's headline, today's topic is 10, 10, 10. Okay. What the heck that's supposed to mean? Do a, are we gonna have to go do a math problem? Okay,
Right?
a lot of people are bad in math. I am no exception, okay? Do not assume that I'm good in math just because I'm Asian. Far from it. But again, you don't need algebra, you don't need calculus to understand the high level numerical concepts. All you need is a common sense and a sixth grade math education, junior high school, whatever. Okay, let's dive deeper into it, and you'll be very, very impressed and overwhelmed by this new strategy that most of you have not learned. And most of you, whether you are a newbie investor or a savvy investor, I bet you have not heard any of these kind of strategies. 10, 10, 10. This is a domino snowball effect. As you can see, the domino.
You're right. I love it. Never learned how to play, but I love it.
Yep. Here are the highlights. Over the next 2 years, if you have the motivation to buy 10 doors, meaning potentially one single family home rental, one duplex, and one fourplex. That's it.
There you go.
With 20 to 25% down financing investment loan. And then I'm going to show you the calculation. And then you can retire in 10 years debt free, even though you started with mortgages, even though you started with financing. And finally, you're able to generate approximately $10,000 in monthly passive income, free and clear for life, adjusted for inflation. So, Julie, how about them apples?
I like that. I like that a lot. I'm doing the numbers in my head.
Yep, that's right. But it's gonna be very conceptual, very simple. So just bear with us. However, yep, just like anything else, Julie, you and I know that for sure. Your journey is begins. Okay, it's a long journey. You gotta take one step at a time. You have to take action and buy your first rental, and then the rest will be gravy. So, very long journey. Okay, so here are the potential types of property you could buy, all right? And again, we're not going to go over the pro forma, or we can spend all the long doing that. This is only going to be a 30-minute podcast. So the first property, single family home you buy, by the way, Julie was our co-host right here. Julie have bought 6 rental properties from this market in Buffalo, Niagara Falls. And we talked about it, your situation, on many of our podcasts. So I was going to learn more about Julie's portfolio journey. There's going to subscribe to our YouTube channel and also subscribe to my email or my website so you can be a free insider, free member of our community. Am I right, Julie?
Absolutely, 100%. Just really great information. So they definitely should sign up.
Yep. So anyway, these are actual properties. So your first single family home purchase, 25% down payment. The interest rate does not matter. Whether you're paying 6.5% or 7%, 30-year fixed rate mortgage, interest rate does not matter. It's not about mortgage rate. It's not about interest rate. It's about buying the right deals, buying cash flow properties, and invest over time and incorporate whatever exit strategies you have based on your unique goals and objectives. But today, we're going to use a very unique exit strategies, which most of you have not learned at all, regardless of your experience level. So pay attention and focus on what we're going to discuss. So this property, single family home, is $67,000. You put 25% down payment. At the end of the day, here are the first monthly cash flow. First year monthly cash flow. Okay, 207. Okay. Then your second property you can buy is a duplex, for this amount, $117,000. And again, with 25% down payment based on the mortgage rate at minus all the deductions and everything else. By the way, I can move so you can move this our visual so you can understand the amazing numerical formulas. Okay, so again, you're welcome to, once you replay the video, you can pause any of the slideshow and digest each slide
Right.
based on what you want to learn, because
Mhm.
you can go over a lot of things. So these numerical formulas are very attractive, is way above the benchmark. That's all I have to say right now. Anyway,
Right.
25% down payment on this duplex 117K, your monthly net cash flow is 736. All right.
Mhm.
And let's go on. And your third property, this is a fourplex, okay, for $173,000, 25% down payment financing. Your monthly net cash flow is 790. All right, the first month. And then your fourth property, you can buy this brand new construction in our new market, which is very exciting, Julie. I can tell you.
Nice.
You and I went over this on our
Right.
podcast last week. Single family home, brand new construction located in Lawton, Oklahoma, which is for $150,000, which is mind boggling.
Right.
Buy any kind of single family home, new construction for only 150K anywhere in the country, in the West. Positive cash flow with only 20% down payment,
Right.
0.75% rate mortgage, and still cash flow 200. So far, so good. Everything's
Oh, absolutely. 100%.
yeah, everything about the cash flow. What more can you ask for, right?
Exactly.
This is the foundation.
Wow.
Julie, this is a foundation.
Nice.
Buying any rental property, you have to achieve cash flow. That's the benchmark.
Absolutely. 100%.
Yep. So you can also buy a duplex in Lawton, Oklahoma, home of the U.S. Army Fort Sill, which is, in case some of you do not know, I'm a military veteran. I'm an Army veteran. I retired with 20 years of actively doing service, Army 20-something years ago. So I know what's going on in this market. Fort Sill, very large military installation where you can get some great tenants outside.
Nice.
Yeah. Anyway, this property, a duplex, brand new, once again, $320,000, 2 units, and you do a 25% down payment once again, and the monthly net cash flow is approximately $624, which is amazing cash flow, amazing returns, cash on cash return, rent to value ratio, almost 1%, capitalization rate 8%. The whole, some amazing numbers. And then
Nice.
the last property you can buy is another fourplex in South Texas. Okay, brand new construction in a very fast growing market, the fastest growing market in Texas, believe it or not, in South Texas, and buy it $545,000, which is amazing value. Once again, very excellent rent, and 25% down payment. So your monthly cash flow is from the start is $773 on amazing return. So at the end of the day, you have purchased this 6 rental property, and I took the liberty of adding all the monthly net cash flow on all 6 properties. Okay, so therefore your monthly net cash flow from all 6 rentals is $33.99.
Not bad.
Yeah, and
Not bad at all.
yeah, and a total down payment for each purchase, right? You leverage it. When you leverage your real investments, your return on investment is a lot higher if you were to purchase in all cash. Yeah. So this is a down payment on each property, on each of the 6 properties. So total down payment, total out of pocket for your goals and objectives is around $378,000, not as 4. So even if you do that, even if you buy these 6 rental properties, you will allocate $375K for cash and down payment. You can trigger right off the bat for monthly net cash flow of $33.99.
That's really good.
Julie, you put yourself in the shoe of a regular investor, which you are. You're part of my member. You typically represent the members within our network, and I have several thousand of them members on your behalf. Do you believe? I know everybody's numerical retirement goals are different, But right off the bat, once you are able to achieve the purchase of these 6 rental properties, that
Right.
will trigger monthly net cash flow of $33.99. Would you say that, hey, even at these numbers, you can pretty much achieve financial freedom just like that? With the-
Absolutely. That's that added on to whatever else you have, a pension or 401k or Social Security. Yeah, that 3,500 just stand alone can be life changing for you. And I'm actually looking at the long term potential of owning that. But yeah, it's starting right off the bat. You're getting a positive cash flow.
Absolutely, yeah. For a lot of people, yeah, you can live with the $3,400 monthly, regardless of your age. You don't have to wait until age 65. So
Mhm.
if you close escrow on 6 of these properties and all the numbers project according to my official
Mhm.
calculation, hey, who's to say you can't retire from this $3,400 per month? You
Right.
know, as long as you may not require to quit your W-2 job. Maybe
Right.
that would be too much, right? That would be
Right.
too
Right.
risky.
Right. Right.
But anyway,
Mhm.
you get what I'm saying, all right?
Yeah, absolutely. Absolutely. 100%.
But I don't want you to retire this early yet. Assuming you have a 10-year long-term financial freedom goal, 15-year, 20
Right.
year, and
Right.
this is the whole scenario. The
Mhm.
crux of this strategy for this podcast is I'm gonna show you how to do a pay down strategy. Debt
Oh, awesome.
debt payoff strategy. Okay.
Mhm.
So anyway, so what you're gonna do, you're gonna gather up all the 6 rentals, all the 33.99 cash flow you have. So you're gonna pay down this extra monthly cash flow, because if you're not ready to retire, what you gonna do with those monthly cash flow?
Right.
You can go out for dinner for two and spend $200 for one
Right.
night dinner. All your cash flow is gone for 1 month. Am I right?
Exactly.
I live in the most expensive market in the country, which is San Francisco Bay Area. I've lived here for
Mhm.
30 years, and you live in Southern
Right.
California,
Also very expensive.
also very expensive. You could go out for dinner just like that and spend a couple $100, and
You're easily,
and your monthly,
yeah.
and your per property monthly cash flow is all gone.
Yeah,
Yeah,
exactly.
so if you want more passive income, more cash flow, you have to invest for the long terms, and I'll show you how. Anyway, so what you're going to do, since you don't need the cash flow currently because you're not ready to retire,
Mm.
you can gather up all the monthly cash flow from all your 6 rentals, equal $33.99, and pay off your lowest loan amount.
Very good.
The first rental we talked about, the $67,000 property, single family home,
Right.
the 30-year mortgage is $50,250. So by
Mm.
paying the principal, by paying one extra principal per month, you can reduce your 30-year mortgage to only a few years.
Very good.
Okay.
That's great.
Just
That's a great
because
strategy.
yeah, Julie, you represent all the investors out there. You
Mhm.
are in their shoes, right?
Absolutely. That's a great strategy. Pay it off early.
Yeah.
Then you can take all that money and put it towards the next one.
Exactly. You pay off the lowest loan amount first. Okay. You and I did not prepare for this podcast. You have no clue
No.
what is the topic. So why someone should pay off the lowest loan amount, accelerate pay off the lowest loan amount first. Why?
Oh, then you're going to free up some more cash flow because once you pay the loan off, about 90% of whatever the rent is coming directly to you. Because minus the, what do you call it, property management fee and maybe minor repairs here and there. But yeah, so then you've got a lot more money coming in once you've paid it off, a lot more cash flow.
Exactly. And also the largest debt you pay off last. The
Mhm.
lowest debt you pay off the earliest, the soonest, so you can extinguish the debt quicker, so you can
Right.
release more money to pay off the second debt.
Exactly.
We are all taught to what when you get a 30-year mortgage, you're paying interest on the 2/3 of the life of the loan.
Yes.
Think about it. If you have not done the calculation, if you get a $500,000 loan and you do a 30-year fixed rate mortgage, regardless of the interest rate, the first 2/3 life of the loan is interest. Only
Yes.
the last 1/3 of the life of the 30-year mortgage is
Mhm.
principal. So you're not getting a $500,000 loan, for example. You're getting a $1.5 million loan amortized over 30 years. So by paying down, by applying the extra principal per month. Look,
Mhm.
apply one extra principal per year, you can reduce your 30-year mortgage to around 22 years, right? Many of us
One extra principal per year, really?
yes, you can
Wow.
reduce your loan from 30 years to approximately 22 years.
Oh my gosh.
Yeah. But the bank and the mortgage lender do not want you to pay off your loan too early because they will not make money off
They
your
lose all that interest. Exactly.
So again,
Wow, that's amazing.
you pay off one extra principal per month. They can
Right.
reduce your mortgage from 30-year loan to like pay it off in about uh, 5 to 7 years.
Wow, that's awesome.
But in this case, you can do it a lot sooner. Okay, let me show you. Okay, just everyone, just pay attention
Mhm.
and follow through on on my slideshow. Okay, so
Okay.
the first loan, right, in Buffalo Niagara Falls, because it's a low cost purchase, is only 50,250, right?
Mhm.
So what you do is use all the cash flow from all 6 rentals. Pay
Mm.
it off. So 50,250 divided by 33.99 equals 15 months. You can pay it off the first loan in about a year and 3 months.
Oh my goodness. Wow.
Now you're feeling good about yourself, right?
That's amazing. Yes.
Major
That's
problems.
great.
Then you can treat yourself out for dinner and spend $200.
Celebrate.
Celebrate. That's it.
Exactly.
Okay.
Mhm.
Okay. But wait, there's more. Oh, sounds like an infomercial.
There you go.
All right. So your first loan paid off 15 months. Then you tackle the second loan. The second loan was a duplex, right? Which I showed. So the duplex, the second property we mentioned,
Mhm.
a 30-year fixed rate mortgage is 87,750. So what you do is, since you paid off the first loan, you were paying $328 monthly mortgage
Right.
on that loan. So since you
Right.
paid off the debt already in 15 months, you could apply that mortgage payment. You no longer have to pay that loan.
Right.
More money, more cash flow
Yes.
to tackle the second loan, right?
No,
So
yes, that makes sense.
the 3299 plus 328 equals
Okay, 3727.
3727. The 87,750, the second loan on a duplex divided by 3727 equals, you can pay off the 30-year fixed rate mortgage
Wow.
in 2 years, 24 months.
That's amazing. That is amazing.
There's more, obviously. I'm going to say this.
Yeah.
I'm going
Man, that's great.
to repeat this sentence. But wait, there's more.
Yes.
These are infomercial.
Mhm.
Okay, now we're tackling the third loan, which is the fourplex for $173,000 fourplex
Right.
up Niagara Falls. So by 3 up, so you have 37. Then we can tackle the third loan, the fourplex,
Mhm.
$130,000 loan
Right.
on that fourplex divided by 3727
3727, right. Yeah.
equals 35 months. We're talking 3 years.
3 years. Yeah.
3
That's
years
amazing.
of paying
Mhm.
back extra principal per month. You paid off your
Mhm.
third property, the loan, the mortgage,
Right.
in about 3 years. Then the mortgage, the monthly mortgage, you have to pay 778. You have to pay
Right.
that loan that the mortgage payment has been extinguished, right? So therefore, you can apply more money on top of this cash flow of 3727. So you
Mhm.
have a new monthly amount you can pay down on your fourth loan. So you
Right.
have $5,077 of available money of cash
Mhm.
flow,
Mhm.
of monthly cash flow to pay off, accelerate, and pay off the next
Right.
loan.
The balance of the loan.
So therefore, this fourth loan is the Lawton, Oklahoma single-family home new construction
Mhm.
for $150,000 loan, or $150,000 purchase, but the loan is $120,000. Okay, on that fourth property. So again,
Right.
so $120K of mortgage balance divided by $5,770, you paid off that loan in 24 months, in 2 years.
Wow.
Wow.
That's amazing.
Unbelievable.
That really is. Yeah, when you, like, really break it down, like, that's such a great strategy.
Yep.
Mhm.
Finally, but wait, there's more. And then you can use the 236,050. That is this is
That was the Texas one, right?
no,
The
this is the duplex.
okay.
This is the Lawton, Oklahoma, $320,000 duplex, the brand new construction.
Okay.
Okay. So that loan is 236,250. So therefore, you have more money.
Right.
You know, the 1529 mortgage
Mhm.
payment you were paying on that fourplex. You can apply that extra money to the already
Mhm.
507. So you have $6,606 to pay it off this loan. Okay. Therefore, it goes 35 months, more years.
Mhm.
You can pay off that loan, the purchase of about $320,000 new construction duplex purchase, and that's done. So 3 years, that's paid off. So then you can apply the largest debt. Finally,
Mhm.
the largest debt is the fourplex in South Texas, the
Mhm.
private one, which is $145,000 fourplex, brand new construction in
Mhm.
South Texas. Okay. And the loan amounts, if you already put 25% down payment, the loan amounts are whopping $408,750. Yeah. So each time you pay off a previous mortgage, the monthly mortgage, you don't have to pay anymore. So you add the extra money into
Right.
the existing money you have, right?
That makes sense.
Yeah. 5277 plus 1529 equals,
Right.
by calculation,
Let's see. The 6,000. Let's see. 6,000. Let me see. Oh, plus the previous 2,200 or 2,600.
2678 or 30-year mortgage on that fourplex in South Texas.
Yeah, so about 4 years. Yeah.
By paying off that fourplex, so you can
Mhm.
pay up 2678
Right.
on top of the 6606.
Right.
You have a monthly monthly money, 9,284
There you go.
to pay off that $408,000 mortgage, and equals 44 months, like 4 years.
Right. Yes.
All right. So my
But,
calculation could be off. I'm not sure, but
it's close enough. And I think people, if you're paying attention, they'll understand that's the whole point of the snowball. I think it's so interesting. Most people think about doing a snowball with your credit card debt. Everybody's heard about that. But doing it with your mortgage makes so much sense because then it's going to free up that mortgage payment, and then that's more money coming in for you.
well, Judy, I'm glad you said this. Okay. In fact, let's share the screen. I'm glad what you just said makes sense. This payoff strategy on a historical basis, on the main
Right.
basis, applies to credit card debt, right?
Right.
Applies to same concept, same strategy.
Mhm. Right.
Because not only it applies to consumer debt, credit cards, student loans, car loans. We all
Mhm.
know consumer loans are the worst, right?
Right.
It's the worst way to have a debt. They call bad debt. Bad
Yes.
debt. For
Absolutely.
mortgage loans, when you leverage your loan through the purchase of investment income producing properties, 30-year fixed rate mortgage is a
Right.
good debt
Yes. Absolutely.
because that good debt is tax deductible. That good
Yes.
debt allow our tenants to pay down the loan.
Exactly.
Anyway, same concept. So I'm glad you mentioned that because
That's a great concept. Yeah.
yeah,
And I don't think most people look at paying your mortgage off the same way you would pay your credit card debt off.
that is the whole point. That's why
Right.
what I'm teaching is really this next level is thinking,
Yeah.
new ways of thinking in a good way, right? And,
Mhm.
you know,
Thinking outside of the box. Yeah.
exactly.
Mhm.
That's why I need you to do my podcast.
Yeah.
The words I couldn't come up with, you can
There you go.
thinking
Great minds think alike.
exactly. That's why we are good partnering when we do.
Exactly.
Yeah, that's the whole idea is to think outside the box.
Yeah, it's already got me thinking. Like the lowest, the 6 properties that we have, the mortgages aren't even close to what you were showing. And I thought, wow, we could pay these off really quick and really just start absorbing all that or receiving all that cash flow. About 90% of the cash flow once we get all the debt paid off.
Look, my concept, you're right. My concept, not 100% of the people, no, embrace our concept, which is okay. Everybody
Right.
have their own, everyone have their own philosophy of doing things.
Mhm.
So we're not gonna get into that. I like it, and that could be one of the your options out there, whoever you are. Nothing wrong to apply this concept, but because
Right.
when you invest in real estate, there are so many quote unquote exit strategies, right?
Mhm. Mhm.
And I'm just showing people another
Right.
strategy,
Yes.
which is the domino effect, the pay down
Mhm.
effect. So you could achieve your financial freedom goal quicker
Mhm. Mhm.
without any more debt.
Exactly.
Think about
That is mind blowing. Even what you said about just paying off one extra principal payment a year can make such a huge difference over the life of the loan. And
Mhm.
I don't think most people understand that. That's huge. Most people can come up with one extra payment, and then if you're a little better off, you can maybe do 2 or 3 or 4. I mean, or 10. But yeah,
Exactly.
that's a great strategy. That is a great strategy. And I don't think I think you really got to sit down and realize because that loan amount looks daunting. When you look at how much it is going to be over the life of the loan, it can depress you. But just doing that one extra payment or 2 extra payments a year on the principal to make sure they understand it towards the principal, yeah, can
Yeah,
make a huge difference in the life of the loan.
Julie, I don't want to toot my own horns, but by being part of my network, you get this kind of great investment concept
Right,
because no one else teaches these kind of things. The
right.
things I'm teaching you guys and other podcasts that you and I've been doing like the last 3 years,
Mhm.
it always going to benefit, all can benefit mostly real estate investors, but it could benefit anybody, right? I'm teaching a money concept that the Wall Street don't want you to know. The
Right.
mortgage lenders,
Mortgage definitely don't want you to know.
right,
They're counting on that 30-year mortgage to pay for their kids' college education and Rolls Royces.
yeah,
But yeah, you can redirect that and benefit yourself. Yeah,
yeah,
that's like mind blowing
it
when you
is.
really think about it.
Look, I've been doing this investing for several decades. Okay, I've been here, done that. So I'm just giving you the wisdom of my knowledge
Mhm.
and my experience, and I give you guys out there a lot of value. Right?
Mhm.
I'm a value add real estate advisor.
Mhm. Exactly.
Judy,
Exactly.
I've been coaching and mentoring, advising hundreds
Mhm.
of these investors over the years, even thousands of many different kind of concepts, including the
Right.
concept that I'm teaching right now, the paid off strategies. Okay,
Mhm.
let's continue. All right, let's go summarize the numbers. Okay, again, this is only sixth grade math. Okay, I'm not asking you to become a rocket scientist, nothing like that. Okay, so therefore, I'm going to add on all the 6 rentals. Right,
Mhm.
the first mortgage was paid off in 15 months. Second
Right.
mortgage, second property paid off in 24 months. Third, third property, the loan paid off in 45 months,
Mhm.
24, 35, and 44, right? Total
Mhm.
177 months. Okay.
Mhm.
Divided by 12 months equal how many years it take off to pay off
Oh,
all these mortgages?
that's
15,
amazing.
yeah, 15 years. Look,
You cut your time in half, and then you saved yourself tons of interest over the life of all those loans. Yeah.
yeah, and you can,
Huge. That's
yeah,
huge.
you can free up more passive income. You can retire earlier than usual,
Mhm.
right? Okay. You don't
Mhm.
have to wait. You don't have to wait for 30 years
Right.
for the tenant to pay down the mortgage.
Right.
Don't have to wait 30 years. You can wait 10 years, 10 to 15 years. Yeah.
That's really good. That's very good.
Look, the calculation that we have done is not real time. It's a lot of things happen. Inflation and
Mhm.
cost of living, everything, the numbers will change. But look, I'm sharing a high level concept. That's all, right? This number is not going to be exact, obviously. But it's the concept that's the most important. So
Absolutely.
you don't have to retire in 15 years. You don't have, if you do not pay off the last mortgage, the biggest one, the fourplex, the $525,000 fourplex in South Texas, what if you do not try to pay off that $400,000 mortgage, right? So you don't need 177 months to pay it off. You don't need to pay it off in 15 years. You can pay off
Mhm.
5 of the 6 mortgages
Mhm.
in perhaps 10 years instead of 15. So this debt paid off domino effect strategy
Mhm.
adjust and adapt to your situation. Okay. And
Exactly.
the property I just mentioned, the 6 property portfolio I just mentioned, Well, this is an ideal portfolio. If you can buy the lowest price investment property, okay, with the highest potential cash flow,
Right.
this numeric pay down strategy will get you there faster. So
Absolutely.
if you're
Absolutely.
buying very high cost income property, like $300 to $500 properties each, they will take much longer to pay down, right? Because your debt
Right.
so large, it'll take you a lot longer to apply this pay down strategy.
Right.
Am I right, Julie?
Exactly. Absolutely. 100%.
Yeah. So therefore, okay, let's continue with this summary. So pay off all in 15 years. 15 years, all 6 rentals, 30-year fixed rate mortgage, completely paid off debt free. Okay, so your total monthly mortgage, if you did not pay off the six rental mortgages, you would continue to pay $4,335, right? Because
Right.
this fixed payment, 30-year fixed is what it is. Your payment will go up regardless of inflation. That's why.
That's true.
So if you do not do the pay off your loan earlier, you will continue to pay on all 6 rentals, 4335. Not you, by the way.
Yes.
Outsource someone else by the name of tenants to pay off
Exactly.
your debts, right? Anyway, so by you no longer having to pay the mortgage payment because you pay it off in 15 years, you get $4,335 of monthly mortgage payment you would otherwise continue to pay. You can free up this money and you can convert it into a passive income cash flow, right? Am I right?
No, absolutely. 100%.
So, yeah, this free up cash flow because you have no more mortgages, plus the original monthly cash flow that we thought is $33.99. 4,335 plus 3,399 equals $7,734 of passive income without rent,
Right.
without factoring the rent increases. The rent increases, Julia, is pretty much a patterns after the inflation.
Right.
If the inflation 3 to 5% per year, then guess what? As a landlord, you could potentially over time can raise the rent in alignment with the inflation increases.
Yeah, I'm glad you made that point, because these numbers are all things being the same, all things being equal. But you got to understand, or your clients need to understand, you will be getting periodic rent increases over the course of that 10 years or 15 years or whatever. So it could even be a much higher number than the 10,000. I think you're being very conservative when you say it'll be 10,000.
Exactly. If inflation is 5 to 6 to 7%, I believe the real inflation is 5 to 7%, not the government version of inflation, which is 2 right now, right?
Exactly. No, I think that's a really good point. And that is something you can retire off. And then if you have your pension or your 401k or your social security or none of those, you can still live very comfortably on 10 grand.
Yeah. So at the end of 15 years, as we mentioned, these numbers are pretty simple.
Right.
You have $7,724. This without any annual rent increases as we just discussed. So it's really, if you factor inflation for the next 15 years, this 7,734 could easily become at least $10,000 of monthly passive income, right?
Yeah, absolutely. Yeah, like I said, I think those numbers are very conservative. Just even looking at how rents have increased in our neighborhood and other places around the country. Yeah, I think those are very conservative numbers, but very doable numbers, very realistic numbers.
Well, absolutely. Like I said, for more than 20 years, I owned a portfolio of real across the country. And I could confidently say that a lot of my rents have increased dramatically. So what's too right?
Absolutely. Just in a few years that we've owned them, we've had several rent increases on our properties. Yeah, that's why I can say I think that's a very conservative number, because just what we've seen in the short time that we've owned our properties. Yeah, I see that.
Yeah.
Growing exponentially.
Yep. In summary, Woody, here's the takeaway. You buy 10 doors, retire in 10 to 15 years, achieve $10,000 monthly passive income. Remember the first slide, 10-10-10?
Right. Yes.
Now you guys know what does that mean. You buy 10 doors, combination of single family home, a duplex equal 2 doors, a fourplex equal 4 doors. And it beats most people. They do nothing. They don't buy real estate, whatever. They can be a slave away, paycheck to paycheck, grinding away, fighting the rat race. They will succumb to their 40-40-40. So Julie, what does 40-40 mean?
Oh, that's a great one. It's so funny. You work 40 hours a week for the next 40 years to retire on 40% less of what you were earning while you were working. And usually bigger numbers are better, but in this case, not so much because no one can live off of 40% of what they were making while they were working because you developed a lifestyle around that. Yeah. So the 10-10-10, and I think that the thing about the 10-10-10, and people just really need to understand that it's like having a lifetime annuity that will increase over time. And for your customers understand what annuity is, insurance companies will pay you a fixed amount of money for your money to use your money. They will pay you a fixed amount for the rest of your life, but generally it doesn't change. There's no cost of living increase on those. But the property, you've got the 10-10-10, you've got $10,000 plus for the rest of your life, which will increase over time. And you own the property forever as long as you keep the properties. And then you can always sell them. You have the opportunity of selling them if that's your exit strategy, to use your words. So,
Julie, not a
better concept.
Look at my next sentence.
Yeah. There you go. I didn't even look at that. I was just talking.
Icing on the cake. Have we, throughout the entire presentation, have we discussed appreciation, equity growth? Have we discussed tax benefit?
Not yet. There's so many other factors that make the 10-10-10 so much more appealing than the 40-40-40.
Exactly. Look, I'm not going to say any more time. If you buy an real estate asset, any kind of real estate asset, if you invest over time on a 10-year cycle, your house, based on 5 to 7 year historical appreciation growth, will double in triple in value sometimes, depending on the business cycle that you're in. So again, the equity, look, you make money, not the cash flow is just the foundation. Okay. Truly, when you make your money as a real estate investor, is equity appreciation.
Absolutely. Yeah. There are just so many advantages to owning real estate.
Absolutely.
Too many to name on this video.
I know.
But go back and watch our other videos because we talk about them.
Watch the other 100 video, of course. And in fact, as we conclude this, so if you're listening, if you're watching, if you receive any value whatsoever from this presentation, please like and subscribe to my YouTube channel. And also, most important of all, is put your email on the description below on my website, so you can become a free member of our real estate investing community of like-minded individuals. So on a daily basis, pretty much, you will receive free education, free video newsletters, similar to the one that you're watching. Continue to get educated through our investment community and opportunities that will present to you at some point in time. You can take action and achieve not only the strategies I can show you, but many other exit strategies. But the most important thing is to take action and go through the long term.
Absolutely.
So, you have any final comment, Julie, before we conclude?
10-10-10. That's where it's at. 10-10-10.
It's 40-40-40 to 10-10-10.
Absolutely.
It's a long journey. You got to have the commitment, the dedication, and the daily discipline and the positive attitude to achieve this goal.
Absolutely.
Not everybody can do it, but you can do it.
Okay. Absolutely can be done.
Thank
you. This was great.
Yep. Thank you, Julie, for sharing your wisdom with me. And you guys out there watching, I will see you on the other side. Thank you very much. Have a nice day.